my name is Lu Ming, and this is my second video for Marshall Peer-to-Peer application. And today I am going to talk about financial performance evaluation for BUAD 281 Accounting 2. So the camera will direct you to the paper on the fridge as I explain. So there are basically three ways when we evaluate financial managers. The first one is return on investment, and the second one is residual income. The third one is ROE, which is return on equity. So let's explain one by one. Return on investment, abbreviated by ROI, is basically the net operating income divided by average operating assets. Okay. This tells us how much profit we are obtaining from our operating assets. It can also be broken up to two parts. The first part is profit margin, PM, equals net operating income divided by sales. This tells us how profitable we are, how profitable this business is, how much net operating income can be generated by this amount of sales. Okay. The second part is asset turnover. Which equals sales divided by average operating assets. This measures the efficiency of our business. In other words, $1 of operating assets can generate how much sales, while the profit margin is $1 of sales can generate how much net operating income. So if we times these two, PM times total asset turnover, give us net operating income divided by sales times sales by average operating assets. And we see that this gets cancelled, which gives us net operating income divided by average operating assets. And it's basically this single formula. So we proved it. Okay. Now let's touch upon the second concept, which is called the residual income. The residual income is basically the net operating income minus average operating assets times minimum required rate of return. Okay. Usually the minimum required rate of return is given, and by average operating assets, I mean that the asset at the beginning and the asset at the end, and we divide it by 2. It's that easy. You can get the information from the balance sheet. Okay. Now, usually, sometimes like when managers are evaluated based upon ROI, then whichever is higher performs better. However, if they are evaluated based upon RI, whichever is higher is better. Sometimes the higher ROI does not necessarily mean the higher RI. So they do not have like the direct or inverse relationship whatsoever. Okay, now the third criterion is called the return on equity. This indicator can be broken up into 3 parts, which is profit margin times total asset turnover, and the third one, it's a new one. It's called asset to equity ratio. Sometimes it's also called equity multiplier. So now it gives you the formula. Net income divided by sales times sales divided by total assets times total assets divided by equity. Notice that here it's the total asset, but in ROI and RI is the average operating assets. And here in this formula, it's net. The profit margin is net income instead of net operating income. So again, the profit margin measures the profitability, the total asset turnover measures the efficiency, and equity multiplier or asset to equity ratio measures the leverage. Like how much debt the company borrow. So is leverage a good thing? It's good for the company as long as you can pay back, because you can use the extra money to make more investments. However, if you cannot pay back, it will be bad because it will incur more interests. Oh, okay. How long is it right now?
7:30.
Okay, so we have one more example to go over. Okay, so the problem basically goes like this. You have a balance sheet, this and the income statement, which summarizes like this. This is operating assets. Okay, and you have 2 divisions. One is called wholesale, one is called retail. And now it gives you all the numbers. $40,000. It tells you that the minimum required of return is 10%, and it asks you which division is doing better. Okay, so let's do it. If we look at from RI's perspective, then wholesales. Net operating income, RI equals net operating income minus average operating assets times minimum required rate of return, which gives you minus times 10. So that gives you 20,000. And then if we do the retail, it's the same thing. It gives you 15,000. Okay. So now if we look from ROI's perspective, we can see, to make things simple, we're not going to use PM times total asset turnover. We're going to use net operating income divided by average operating assets. So for wholesale, is going to be 120,000 divided by a million, right? Which gives you 12%. Now the retail gives you 16%. So which division is doing better? Well, from the RI's perspective, the wholesale is doing better. However, from the ROI's perspective, retail is doing better. It really depends on which method you use. Okay, so now we want to ask what makes the ROI different? In other words, what causes it different? As we know that ROI is divided into profit margin and total asset turnover. If we see for the wholesale, the profit margin equals net operating income divided by sales, which equals 24%, right? And the asset turnover equals the sales divided by operating asset. That gives you 0.5. Usually total asset turnover is a number instead of a percentage. And for retails, similarly, it gives you 10% of profit margin, 1.6 total asset turnover. So you can see what is really different and what is the reason. So yeah, that's basically the lecture. So thank you for watching.